After starting Sunday evening, down, I think eventually got down to 2% drop overnight. We came roaring back to the point where we actually finished with a gain on the S&P 500. So nice little rally off of what was an opening gap to the downside, fill in that gap immediately. Now the question is, was this the pullback? Was this enough of a pullback that we can get a nice little intermediate run out of this, or do we still have some dropping left to do, or are we just going to grind around? That's the big question. We all want a trend. The market's been so binary, moving so far either up or down. What's going to happen? We don't really move one way or the other. So we're going to talk about that today in our market outlook video. And then our trade idea of the day is a stock that looked like the market for a little bit of time, but has since kind of broken down. So we're going to, in a really strong sector. So we're going to talk about how to trade that. So let's go ahead and get started. Today is Monday, May the 4th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's go ahead and start off by taking a look at the S&P 500 with the market forecast indicator. You can see a little bit of a bounce here today, a little bit of a piercing line type pattern where you gap down lower, rally throughout the day. Of course, we're still in this space between this 2950 and 2650 where going up or down is, there's no trend yet. And you really need to break this before we can really get good established on a bullish trend. But we are in a bullish posture nonetheless. At least that is the bias right now. Long-term market sentiment's rising. We have this pullback in short-term sentiment that started these last couple of days, and you can see the near-term line has made its way to the 20th percentile and that did not get into reversal zone. And if you recall from Friday's video, that the momentum line did not get to extreme oversold. So that's a positive development. It did in the Russell 2000, was oversold again and has dipped below 20 today. So a little bit worse of a short-term sentiment in the Russell. Not as bullish, of course, lagging behind. It's been the problem with the Russell. It's had a few really good updates here when it kind of broke through this 38% level. But then that was like the last of this bullish rally. It finally participated in the bullish rally and now is back down. But at least still holding, right? Still holding. It took a while to get into the reversals, into the resistance zone here. Resistance in this case, because we're moving up into it. If you're moving down into it, it'd be a support zone. But this Fibonacci resistance zone that we're in, it took a while. It was holding up. It was lagging behind. But it finally broke through, and now we pull back down to the lower end of it, but still are in it. So it's we were kind of flirting with breaking through the bottom of it. And again, breaking through this level would be a good sign that we're reversing the bearish trend now, or reversing this pullback and start renewing the bearish trend that we have. And this would obviously be a lower high that we have going on. If you take a look at some of these other indicators, again, it's going to be really important to see what happens at the 60 level. You can see we're stuck between 50 and 60, where we're above 50, so it's bullish, but we're not above 60, so there's no trend. We're flirting with staying in the upper half of the chart here. We're dipped below zero. We'll see how far, whether we stay below zero or not. When you're bullish, you don't get below zero for very long. You jump right back up. But once you start, you can see a little bit of a red flag there when we are bearish. And here's the intermediate pullback, and here's an intermediate pullback. That's when, you drop below 50, you drop below 40 even on both of these. You drop below negative 200. And we're starting to get a pullback, and we obviously got that way over here, but the flip side of that is to break out, and we haven't really broken out to the upside. It's almost like when you pull back to 40 and you're not able to really break through the downside, you bounce off of that. This is just the other way around. And of course, when you look at the trend strength indicator for the Ichimoku cloud, we pulled back to the top of the cloud, which we're now holding for support. We're below the green line, but still above the blue, so that's a good sign. The trend, again, is still kind of in this sucker zone where you're above 2.5, you're above 2, or you're above 65, so it looks bullish, but we're not above 5 and 80 to where we're okay. We're on a bullish trend. So lots of signs that, same thing with the retracement zone. Things look more and more bullish, but not bullish enough to trend yet. That continues to be a kind of a theme. So we basically we expanded the space that we can trade in with this drop, and we've filled in the space with the rally because this move was so big, but we're still not able to, again, we're above 25 on the positive directional index, not above 30, and that's where you need to be to have a really good trend going. And then have obviously the negative directional index get below and stay below 20. That'd be ideal, and that hasn't happened yet. I mentioned the space that you see here, and I mean that's the space that the bandwidth got really big. So when you have a really wide bandwidth, you can trade. I mean, just to get up to that spot and stay in the lower half of the bandwidth was quite the move. And now we've broken through in the upper half of the bandwidth with both lines rising, but you don't have the top band rising anymore. The top band's kind of started to slow down. It's actually started to fall with the bottom band rising. So you have a really small. The bandwidth is, it's still high compared to where it's been. If you look at the last couple of years here, just for some context, that's a relatively high level. I mean, we got higher than that at the very end of that move. We got a little bit higher than where we're at now there. So it's still a relatively wide bandwidth. Still room for it to shrink, and you can see, in the 3-year chart how far we can pull back here. But on the 1-year chart, that point of control is still up above us, not below us. So until we can break through there, that's going to be a limiting factor. And if you look at the IWM, you can see we're not even in the, we've pulled back into this area where there's some support, but we're not even in the value area. So, that's the problem for the small cap index versus, say, the QQQ, which is not only it's gone through the other end of the value area. I mean, so you have a really wide discrepancy here, divergence between the Nasdaq 100, which is so bullish that it's above the area where 70% of this year's volume is traded, well above the point of control. And then you have IWM, which is below its value area, with most of its volume above us, significantly above us, where we're at right now. So pretty wide divergence, and you have in the middle the S&P, which is basically caught in the middle, right? It's not as bearish to be below, though it's closer to the lower end than the upper end, and it's below the lower half, below its point of control. So it kind of shows you, that if we're going to be bullish, there's really a small subset of stocks to be bullish with. Even these value stocks that are so beaten up, they're still really lagging behind the growth areas that are the where a lot of these QQQ type names exist right now. Alright, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video that will notify you when these videos are posted. Also, hit that thumbs up icon that's down below the video. That tells us two things. Number one, you liked your video today. And number two, that you want us to do another video again tomorrow. It's a quick way to give us feedback. If you like our stuff and you want us to keep doing it, let us know with one click. If you don't like our stuff, then you don't have to click on anything. As always, two comments down below as what you got out of our video today. We always like to hear that. Join our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. Click on that link, takes you to a page where you can subscribe to our site for free. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. Also, if you're watching this on our website, you can check out a few things that we have here. Here's a link to our Market Outlook live trade review videos that we do. Whenever I do the Market Outlook, I always do this before the market closes. I review all my old trade ideas and continue to manage them until I close them. And then we put on today's trade idea before the market closes so we can avoid the gap in the morning. Sometimes it's not in our favor. Our calendar of classes is right below that. You can check out all of our classes there again. All of our monthly subscribers get access to all 8 of our trading rooms, and then you can check them. You can cancel at any time. So if you want to check out our classes, sign up for our monthly plan there and check those out. Those are the ones that we have coming up here. You can send us an email with this little icon here in the bottom right corner, and you can get notifications here by clicking on this little bell. Click this heart. This will open up a new window. You can like today's Market Outlook tweet there. Click that thumbs up. It takes you to your Facebook page. You can like today's Market Outlook Facebook post. Again, that benefits us because the more likes there are on these posts, the more Twitter and Facebook will promote our content to all of our followers. It benefits you because they will promote content in your timeline from the accounts that you engage with the most. So we try to make it really easy for you to engage with us. All right, now let's take a look at the weekly chart. And again, there's three things we look for on this chart here, this weekly chart. And that is, number one, a higher high, which we currently are not getting right now. Number two would be a higher close, which we are also not getting right now. And number three is no lower shadow, which we already got a lower shadow and a very small body. It's turning into what potentially could be a transition candle here. Very, very small candle coming off of some bullish moves. We don't always see these candles. And when you look, let's go out as far as we can at some of these really significant declines that we've had in the past. You can kind of see here, this was a small body, but a relatively big candle. And then as we rallied off of this, we didn't really get the big bodies. And some of these rallies, by the time we got the small body, we kind of held that 200-day moving average that happened to be at the 200-day moving average. You look at the July here, we had the big rally. There's the reversal at the 50-day moving average. There's a reversal, a couple reversals here closer to the 200-day moving average. You go out to that 1987 peak, and you can see, big body here, a couple transitions we never did fall over. So you can see it's not necessarily something that dictates whether or not we're going to really roll over from here. But we also have some, bigger bodies here. Here's some bigger bodies that we got coming off of a rally under the 200-day moving average. And here's another one, a couple big bodies. But these are some of the bigger bodies that we've seen on the S&P 500. So this indicator down here at the bottom represents how big the Hakinyashi candles are. And you can see that the Hakinyashi candles, at least this one here is the biggest one that we had, was 7% of the value of the S&P, or really darn close to it, 6.97. So one of the biggest Hakinyashi candles we have. You can see the average, this is a 3-day average, 3-period average. And this, of course, weeklies. And you can see we never did get a weekly candle that high. We were up to 5, we were up to 5, we were over here to 5, but never did get in close to that level there. If you look over here at 2002 again, the candles never did get close. In fact, our biggest candle that we had during this run was in 2000. We had a big run, big large candle up there. You come over here to 1987, you can see the bullish candles we got, not even close to as big as we are now. So we've relatively big candles. Here's some bigger candles coming off of these lows at the end of 82 that really kind of started this rally, got us through that 200-day moving average there in one fell swoop. That's really hard. I mean, you can see how easy it is to get really big downside candles, but really hard to get the big upside candles. Here's another one that we got coming up off of this 1974 low point that was close to 7%. And you can see it back here in the 30s. These candles were huge, right? And eventually that we rolled over, the size of those candles rolled over, and this is weekly candles, mind you. But eventually the size of these candles rolled over before we got the transition. And then by the time we got the transition, you can see we were negative. We had gone through the 200-day moving average at that point. So we kind of had some strong momentum and then really rolled over. And then consider, when you're on bullish trends, usually you get your, you start to get your biggest. So here you can see you got your biggest candles at the beginning, and then we kind of slowly, get smaller candles. That's not surprising. You look at all these other more recent bullish trends here. You get your big candles early, and then we kind of grind lower, coming off of these low points. You got your big candles early, the biggest ones, and then we kind of grind down towards zero as we roll over. That's your typical, right? Well, here we got our big candles now, and we're going to start getting really small candles as the average, you can see, the smooth average here is rolling over. In this case, we're doing it not above the 200-day moving average like some of these others, but we're doing it at the 50. So a little bit of it, and also at this upward trending resistance line. So, just an idea. That's consider it a transition. That's something we want to keep an eye on throughout the rest of this week and see if we can't push up a little bit higher one way, push in one direction at least, one way or the other. Otherwise, it's going to be really grinding for the next potentially couple of weeks here, according to that candle. You look at the 3 green arrow chart, and you see we don't have 3 green arrows anymore. We have a loss of momentum, and your stochastic indicators has turned down. So not surprising. We've talked about that before. It's finally starting to roll over. We're below the 8-day moving average. Today's bounce up basically got us back to the 8-day moving average, but not through it. So we're not back on that bullish trend yet. But we're also not really bearish either. Just some negative or below moving averages, and we'll see how long that lasts there. All right, let's take a look at the intraday chart here with the S&P 500, and you can see today we filled in this morning's gap. We started down lower, we rallied up higher. I showed you before this gap study here, how we flip from one side to the other. Well, we've had 3 days in a row now of gaps to the downside, and really the only gap of significance that we had was Friday's, and we haven't filled that one in yet. That was a pretty significant gap, but not one yet. I mean, if you look at some of these other gaps, like this runaway gap here, that was a pretty significant gap because we were well above 2 standard deviations. We were beyond, going towards 3 standard deviations at the time. So pretty significant gap there. And you can see a couple, here's the gap that we still haven't filled in yet either, that we've talked about before, the April 6th gap, that as a potential kind of worst case scenario as we pull back. But all the rest of these, even the 1 standard deviation moves, have been to the upside. So I expect that we'll fill in that gap too. I don't think it's any significance. Of course, remember the runaway gap we had over here, it looks really small, but you have to put that in comparison on the gap on 224. If I change my time frame to kind of show you how significant that runaway gap was compared to its standard deviations at the time. All right, so let's see here. That was a huge, that was like 5. I believe that's a 5th standard deviation down there that was thrown on. Way significant move to the downside. So, that's a runaway gap. That one's not going to get filled in. It hasn't been filled in yet, even with this current rally that we had. And then you go to the March 24th low point. As big as the selling has been up to that point, that was a pretty sizable gap too. Not quite 5 standard deviations, and we had one before too that was really significant that ended up getting filled in that same day, right on March the 13th. Because that's the other issue when you look at these gaps to see whether or not they get filled in. Again, these runaway gaps don't get filled in immediately. So March the 13th, there's the March 24th. If I go back a little bit further to the March 13th time frame, so right in here, there's the March 13th right there. Can't really see it as well without zooming in, but you can see we gapped up really sharply, filled right in immediately by the middle of the day. In fact, within 2 hours we had filled in the gap. So that kind of shows you that not a runaway gap. But here, within 2 hours, we hadn't even sniffed filling in the gap. So that's a runaway gap, and when you have a significant move. So to put that into a context, Friday's gap was not a runaway gap, like a downside runaway gap like we had over here. Not nearly significant enough. So we're going to fill that in, but we're also still going to fill in this one too that we haven't filled in yet either from April 24th first. So in other words, we're going to be grinding here. We're going to grind up, we're going to grind down, we're going to have range, we're going to be filling in the space, and really no trend yet. As you can see, this low point is going to pop up, and after today it's going to pop up. After tomorrow it's going to pop up some more. By Friday we'll be right up into here, and we'll be close to that for a couple of weeks. Will be our low point for the next couple of weeks here. Well, that's close to 274, 272. We're at 20 points now, so we're well below 10% for the first time in a long time. We're going to have below a 10% gap. Remember, 10% is a pretty wide range as it is. So we're going to really start grinding away within some highs and lows here for a while within this space. And it might be frustratingly grinding for some, but at least there won't be a clear direction. I think what we're kind of hoping now is we don't get a big clear move, a sharp move to the downside. Like I said, I think that move right there to fill that one in is our worst case scenario, and I don't think that was a big enough of a gap not to fill in. So that would be this right here, above 2 standard deviations. So significant gap, but still, not significant enough that we can't fill that in. So we'll see that again. I think that's our worst case scenario for any pullback, is to head towards that direction. Otherwise, more likely we could just kind of trade between this low point here around maybe 272 and a half, and that high point up there. If we take a look at today's volume and range, very, very minimal volume and range today. The volume was 80 million, 81 million. The range at less than 5 points. So, in other words, when you look at the range compared to, we're still kind of floating around that 3% level. 3% right now of 283 and a half is 8.5 points. So, our range, our ATR right now is at 8.5 points. So we're going to kind of keep an eye on the more we get small ranges. Even if we just go sideways, the better, because that means we break this 3% mark and start heading back down again. And we've talked before, when we've had these big 5+% spikes in ATR, we usually hit the support at the 3% mark and then form the low point that we ultimately come up off of after that. Again, it doesn't have to be a lower low, it doesn't have to be equal low, it can be a higher low, but usually that's when we form the low point after we've pulled back towards the 3% mark. Let's take a look at the volatility index now. You can see volatility pulling back below 100% today. Still in the kind of in the bearish territory, the low end of the bearish territory. We're above the neutral zone at 95%. So again, it looks more bullish than it is, right? We're not really bullish trend until we break the 90% mark. We're falling and we're below 100%, so it looks bullish, but not quite bullish yet. Kind of following a similar theme here. All right, so to summarize our technical outlook before we look at some of these other relationships and our trade idea of the day, again, we look bullish. We've had a good bullish run. We've had a good bounce off of a significant lows back in March. That bounce has been slowing down. We've been up and down here lately, the last week or two, but we're not bullish enough yet to really say the lows are behind us and that we're now going to trend higher. Especially considering that we're still below the 50-day moving average, which is also still below the 200. So we're not nearly out of the woods yet on this. So we just, again, it's not like we're expecting I'm not expecting a deep bear market. I'm not expecting a drop to significant new lows. I don't even think we'll get to lower lows. We could, but I don't even think we'll get to that. But I do think that we're not also in this binary market where we either are going to go down all the time or we're going to go up all the time. That's the problem with markets, especially kind of with the media that tracks it, is every time there is an up or down move, we're either right back at it, and then all the media is, well, maybe the markets are showing us to be more bullish than we should be, or we turn back down and we have markets in turmoil sessions every night. So, the markets aren't that binary, and right now we're in that kind of no man's land where we just go back and forth within space. Before we break out one way or the other. And I don't expect that breakout to occur at least for the next few weeks, at least the next couple of weeks, excuse me. So what do you think? Do you agree with that assessment? Do you disagree? There's a link popping out right there at the top right corner of your screen. Click on that link. It opens up a poll. Then hit either agree or disagree. If you click disagree, comment down below as to why. What are you seeing that suggests otherwise from what we just came up with here? All right, now let's talk about the different intermarket relationships. And you can see on this 3-month chart, we are still in risk-off mode. As bullish as we've been here, we're as oversold as we were. All we've accomplished in this past little rally is not to be as oversold. We're still bearish. You can see bonds are still up. They haven't really dropped at all since their peak early on in the selling. It dropped initially there, even with stocks dropping. But has since kind of maintained. In fact, off of stock's low point, bonds are higher than where they were when stocks hit that low point. Gold is significantly higher than where it was when stocks hit that low point. High yield bonds are up higher, and that's what you'd expect. But not as, you can see stocks haven't crossed that threshold yet of outperforming those areas. And you can see international stocks still lagging, and you can see small cap stocks still lagging. And that was the case today. If you look at value versus growth, if you look at QQQ versus IWM, almost 3 times the return that IWM got. If you look at international stocks, EEM actually had a pretty decent day. EFA did not, coming in well below the S&P 500. So you get the sense that we're still not getting the leaders that we want to see lead us up on the upside. And so what that means is we haven't formed the low point yet, the low point. And again, when I say the low point, it doesn't have to be, it doesn't have to be higher, lower, or equal to that low point where we had the heaviest selling, right? It just is the low point that we bounce off of that starts the bullish trend from there. And that's something we need to keep our eyes on. If you take a look at how some of these charts look like, here, let's go to the 10-year yield. Right, again, from a risk asset standpoint, we all know that stocks have their bullish pattern. U.S. stocks have their bullish pattern. International stocks have a somewhat bullish pattern. EEM also kind of just getting going here, but TNX not showing that yet. Commodities not showing that. Light green shading, but still not showing the bullish trend yet. So we're still not getting, and of course IWM we can see almost looks like EFA and EEM. We're still not getting the full across the board selling. High yield finally looks halfway decent with the pullback. That green line's rolling up and it's pullback there. But then of course you look at the dollar and you can see the dollar is on a dark pink shading and a red line, and that's what we want it to be on. That's what we want it to stay on. From a weekly standpoint, you can see we're still kind of messing around up here. Still very, very noisy. There's no trend going on the dollar index. And for stocks to really be bullish, we need to see a good trend here. If I look at the weekly charts, look at the weekly time frame. Let's go out to a weekly here. You can see we haven't had much of a trend at all, to say the least. Look how noisy it's been. We had a little bit of some ups and downs here of bullishness, but we've been since the beginning of 2019. Remember I mentioned before that the bear market started there and really started here in October. That's where the bullish trend for the dollar ended. We had this bearish move in the dollar, very strong bullish move on the dollar that ended at the end of 2018. We've been kind of grinding up ever since. But again, that's not usually a bullish sign for stocks to ride higher. The stocks like to see a good, strong, bearish trend, because that's when you get your biggest gains, as we saw in 2017 going into early 18. We had a huge gains on the S&P 500 and U.S. stocks. And then, of course, we really kind of, that after QE3 ended in October 2014, the dollar took off like a rocket. And stocks didn't go down, but they struggled throughout most of 2015 and before they had the death cross environment at the end of 15 and the beginning of 16, where this bullish run finally ended. Let's take a look at the major economies out there and how they're all comparing on their 12 grid here. This is the 12 biggest economies and their ETFs that track their stocks. You can see China, even with EEM's outperformance, China pulling back, giving us this pattern of light pink shading, yellow line. Italy is close, so our two kind of biggest early hit areas with the coronavirus. Everything else is kind of just, dark green and green line, but pulling back to the green line. So the question is whether or not they're able to maintain these kind of burgeoning bullish patterns here of dark green shading and green lines across the board. And obviously we can get back to, we're just barely below 80, so we can get back to dark green really quickly on both China and Italy there. So, it's a broad rally from an international standpoint. It's just a matter of who's leading, and the dollar has been keeping these international stocks from leading. And again, if we want the stocks to maintain a good long bullish move and extended with good upside, then we need the dollar to give up some of those gains and start working its way a little bit lower. So if you look at like some of these major currencies here, like the euro, for example, which is the dollar index is about almost 60% how the dollar is comparing relative to the euro. You can see the strong bearish trend the euro has been in pretty much since the beginning of 2018. If it wasn't for that trend, it would look a lot worse, right? The U.S. stock market. But the euro has been really sharply lower. It's down to lows. The question is whether or not now we're going to be able to sustain any more bearish moves, as we had these big candles that were kind of consolidating here. So is the euro finally going to start making its way to the upside? Here's the market forecast for the euro. Its intermediate line finally crossing up above 50. We had a brief little run right there. And now we'll see if this bullish trend, if this little bullish intermediate confirmation signal gives us a little bullish bounce to the upside. If this bounces to the upside, we would expect stocks to bounce up along with it. All right, now let's take a look at how the sectors are performing. And you can see healthcare has had a nice little run off of this low point. In fact, let's just go back to the March 23rd low point and take a look at, we'll go to the 24th and include that gap there, and take a look at how stocks have been performing. There's energy stocks really rallying sharply off of that low point. You can see materials as well up, outpacing the broad market, and then you see healthcare. You still have industrials and financials lagging behind. Communication services also lagging behind there. Technology and discretionary are outpacing the markets by a little bit, and utilities and real estate, which were the big winners originally off of this low point, they started to kind of lag a little bit after they peaked here. This would be the 4.9. So 4.9 was that gap that we haven't filled in yet, right? So after we started from that point going forward, they've actually lagged behind along with staples. Financials also, interestingly, and industrials down there too. They've really dropped here sharply the last a little bit. And then you can see how the FANG stocks have took over. So it was energy, it was utilities, it was real estate on the initial thrust off that March 23rd low. And then the FANG stocks really took hold, along with energy also moving up. But since that peak here on 429, so if we go to 430, since the market peaked and we've been kind of rolling over to the downside, let's go to a 10 minute. You can see the selling has been very concentrated in energy and in financials and industrials. So these big companies that have been hit the hardest by this COVID disease and the coronavirus, they really have been hit hard this past few days too. Technology holding up okay, discretionary holding up okay, healthcare. So all these large cap tech names holding up. And as we bounce back up, you can see that they're outpacing. But again, these are these cyclical sectors that you want to see beating the market too. And so it's great to have these QQQ names leading us up to the upside, but they can't. We can't have them. Again, it's the small caps that lead the way, and those two sectors are really highly represented in the small cap index, and those are the sectors that we want us to lead, at least to have a good run. It doesn't have to be the top two sectors, but they have to be up there. We can't just be so concentrated in a few large cap names. We've seen how that story's ended before, and it looks like we're headed towards the ending of, it looks like we're in that story again. All right, so before I traded the other day, I looked at a stock that's actually kind of that's not nearly as bullish as its sector would have us think it is, and that's Merck. Merck had a nice little rally off of the low point, but has since rolled back down. So you think, this got a pretty bullish pattern here. The problem is that you have we are, that's a pretty decent drop in short-term sentiment. The intermediate line's falling down at a pretty decent clip here. Something very similar to over here. Now we had a little bounce briefly before we rolled over and got the dark pink shading in the red line. If you look at the weekly chart, you can see it doesn't look nearly as bullish as we think, right? We have dark green shading, but we still have the red line. We got right up to the 150-day moving average. We hit it. We're rolling over. The red line is still falling, as you can see. There's times that you can get dark green shading within a red line, and this was it, right? To really turn things around, you need dark green shading in the green line, and we're not there on Merck. We're definitely not there on the S&P, no matter how bullish we've been. And QQQ actually never really got the dark green shading in the pink, dark pink shading in the red line, right? It's we've turned right back around, and then you look at like the Russell 2000. And it's not anywhere close to changing that red line there. So in other words, we're on a bearish trend, and Merck is a representative of that. If you look at its Bollinger Bands here, you can see that it's breaking down below the value area. So it got up to its point of control with that little rally here with its earnings, before its earnings, and then dropping sharply down since and breaking back down below its volume node, and not a lot of volume because we went down and up so fast. There's not a lot of volume down here. There's a lot more volume above us. So path of least resistance right now is to the downside for the stock. You can see this little rally also failed to get us up above 16, above 200, very similar to the S&P, little double top pattern breaking through the low point there. You look at its DMI for Merck, and you can see its negative directional index breaking back above 20, not above 25 yet, but its positive is back below 20, barely stayed above and never did get above 25. So kind of shows you how weak this little rally has been. Very, very weak. If you look at its trend strength indicators, you'll notice that we've now come back into the cloud. We don't have a bullish trend anymore. But if you look at its weekly, we're still on a pretty strong bearish trend, like moderately strong bearish trend according to this. So, it's one of those stocks that looked a lot more bullish than it is, and we have an opportunity here to take advantage. I was going to show you the crossover here on this chart. You can see coming back down, hitting the 200, rolling back over, getting us coming back below the falling 50-day moving average after that. After a couple of transition candles there, you can see lower lows, lower closes. We're not closing below yesterday's low, but no upper shadow. It's a pretty bearish Hakinyashi candle. So it sets us up for a bearish trade. So what we did here, normally we've been doing some long put verticals, but with this one we decided to go with a short call vertical spread. So selling the 80, buying the 82.5. Relatively, we got a lot of bearish things in our favor here already, with the fact that we've already rolled over. So that's kind of takes away the directional opportunity and has us looking at more of a higher probability setup. And we're position size without the earnings here. We're position size around a full position, a normal position, going for 50% of our maximum gain. So if we can get 50% of that maximum gain quickly within a week or two, great. Which tend to happen more on bear call spreads. If we don't, then we've got some upside that if the stock goes up, we got some room up here for it to keep going up and still maintain. I'd be willing to lose $456. But otherwise, until I get to that loss, or if I don't get this gain quickly, then we'll just grind this out and try to get to that 450. So almost 50, about 45% of how much I'm putting at risk. All right, so that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link to go to our Market Outlook forums on marketscholars.com. Open up any new thread with any questions or comments you have about the video today. Reply to other people's threads. And let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video. Follow us on Twitter for more content between videos. Join our community at marketscholars.com, like I showed you earlier, for free, as well as join our Market Outlook Facebook group that we've created. Have a great rest of your Monday night, everybody, and we'll see you all next time.